Before Credit Karma arrived on the scene in 2007, checking your credit score was like visiting a financial fortune teller who charged you $20 just to peek behind the curtain. The credit monitoring industry had built an empire on information asymmetry, charging consumers monthly fees ranging from $15 to $30 for access to data about their own financial lives. Companies like Experian, Equifax, and TransUnion weren't just the gatekeepers of credit information. They were the landlords, and every time you wanted to see your credit score, you paid rent. This wasn't some luxury service. This was basic financial literacy being held hostage behind a paywall. The big three credit bureaus had created a perfect storm of consumer confusion and corporate profit. They'd convinced millions of Americans that monitoring your credit was essential for financial health, then made it expensive enough that most people only checked sporadically, usually when applying for loans or after suspecting identity theft. The annual revenue from credit monitoring services exceeded $2 billion by 2007, built on the simple premise that your own financial data was worth paying to access. MyFico charged nearly $60 for a single comprehensive credit report. Experian's premium monitoring service cost $25 monthly. Even the so-called free annual credit reports mandated by federal law came wrapped in upsells and premium service pitches that left consumers feeling like they were getting the bare minimum unless they paid extra. Enter Kenneth Lin, a former e-loan and bank rate executive who looked at this industry and saw something that would make any disruptor salivate. A massive market built entirely on artificial scarcity. Lin understood that credit scores weren't actually expensive to generate or access. They were just expensive because the industry could get away with charging for them. In March 2007, he launched Credit Karma with a revolutionary proposition that sounded too good to be true. Completely free credit scores, updated weekly, with no strings attached, no credit card required, and no hidden fees lurking in the fine print. The initial skepticism was overwhelming, because consumers had been conditioned to believe that anything truly valuable in the financial world came with a price tag. Credit Karma's early marketing had to overcome not just competitor resistance, but consumer disbelief. The company offered TransUnion credit scores through a clean, simple interface that took minutes to access rather than the labyrinthine sign-up processes that traditional credit monitoring services use to justify their fees. Lin's insight was brutally simple. If you could make money by helping people access their credit information rather than charging them for it, you could scale infinitely faster than the incumbents who were essentially taxing financial awareness. The business model flipped the entire industry on its head by treating credit scores as the hook rather than the product. Credit Karma's revenue model was elegant in its simplicity and devastating in its effectiveness against traditional credit monitoring. Instead of charging consumers for access to their credit data, the company made money by using that data to recommend personalized financial products like credit cards, loans, and insurance. When someone with a 720 credit score logged into Credit Karma, they'd see their score for free, but they'd also see targeted offers for premium credit cards that actually matched their credit worthiness. The company earned affiliate commissions when users applied for and were approved for these financial products, creating a revenue stream that grew alongside user engagement, rather than limiting it with paywalls. This model generated significantly more revenue per user than traditional subscription fees, because a single successful credit card referral could earn Credit Karma anywhere from $50 to several $100s, far more than a year's worth of monitoring fees. By 2010, Credit Karma was generating over $20 million in annual revenue without charging users a single penny, proving that the subscription model wasn't just customer-unfriendly, it was economically inferior. The company's approach turned credit monitoring from a cost center in consumers' budgets into a value-added service that actually helped them access better financial products. Traditional credit monitoring companies found themselves in the absurd position of charging people for the privilege of seeing advertisements for financial products, while Credit Karma was getting paid by financial companies to show those same ads to more qualified, engaged prospects. The user experience revolution that Credit Karma brought to credit monitoring made the traditional players look like they were operating with technology from the Stone Age. While Experian and Equifax required users to navigate through multiple verification screens, answer security questions about decades-old addresses, and often forced phone verification for simple score access. Credit Karma streamlined the entire process into a sign-up flow that took under 3 minutes. The platform updated scores weekly instead of monthly, sent proactive alerts about credit changes via email and mobile notifications, and presented information through intuitive dashboards that actually helped users understand what factors were affecting their scores. Credit Karma's mobile app, launched in 2012, made credit monitoring as accessible as checking social media, while traditional services were still primarily desktop-based with clunky mobile websites that felt like afterthoughts. The company invested heavily in educational content, providing detailed explanations of credit factors, personalized recommendations for credit improvement, and calculators that helped users understand how different financial decisions would impact their scores over time. By 2013, Credit Karma users were checking their credit scores an average of 12 times per year, compared to the industry average of just twice annually for paid services, demonstrating that removing friction and cost barriers led to much higher engagement with financial health tools. The platform's credit score simulator allowed users to model the impact of paying down debt or opening new accounts before making those decisions, a feature that would have cost extra on traditional platforms, but was included free as part of Credit Karma's comprehensive offering. The competitive response from traditional credit monitoring companies was a masterclass in how not to handle disruption, combining denial, half measures, and strategic blunders that only accelerated their decline. Initially, companies like Experian and Equifax dismissed Credit Karma as a marketing gimmick, arguing that consumers needed the comprehensive monitoring and identity theft protection that only paid services could provide. They doubled down on fear-based marketing, emphasizing credit monitoring as insurance against identity theft, rather than acknowledging that most consumers simply wanted to track their financial progress without paying monthly fees. When the threat became undeniable by 2011, the incumbents launched their own free offerings, but these were clearly designed to funnel users toward paid upgrades rather than provide genuine value. Experian's free credit score came with constant upsell prompts and limited access to detailed credit factors. Equifax offered free scores but buried them behind marketing walls that made Credit Karma's straightforward approach look even more appealing by comparison. The traditional players couldn't fully commit to free services because doing so would cannibalize their existing subscription revenue, creating a classic innovator's dilemma where protecting current profits prevented them from competing effectively for future market share. MyFico, which had built its entire brand around providing the most accurate credit scores, found itself in the particularly awkward position of arguing that free scores weren't worth having while simultaneously launching its own limited free offerings. By 2014, the major credit bureaus were spending more on marketing their free score offerings than some companies' entire annual revenues, desperately trying to reclaim market share they'd lost by underestimating how quickly consumers would abandon paid services once a quality-free alternative emerged. Credit Karma's growth trajectory during this period was nothing short of phenomenal, demonstrating just how much pent-up demand existed for accessible credit monitoring. The company grew from 200,000 users in 2008 to over 2 million by 2011, then exploded to 15 million users by 2014 as smartphone adoption and financial awareness campaigns drove mainstream acceptance of regular credit monitoring. This growth was almost entirely organic, driven by word-of-mouth recommendations from users who couldn't believe they'd been paying for something they could get free. Credit Karma's Net Promoter Score consistently exceeded 70, meaning that the vast majority of users were actively recommending the service to friends and family, creating a viral growth loop that traditional credit monitoring companies couldn't match with their paid models. The company's user base was also significantly more engaged than traditional services, with average users logging in monthly compared to quarterly check-ins for paid services, creating more opportunities for product recommendations and higher lifetime value despite the lack of subscription fees. By 2013, Credit Karma was processing over 30 million credit score updates monthly, handling more volume than some traditional credit monitoring services had ever processed in their entire existence. The platform's growth coincided with increased consumer awareness about credit scores driven by post-financial crisis lending standards. But Credit Karma captured the majority of this expanding market by being the most accessible entry point for credit monitoring. User demographics skewed younger and more diverse than traditional credit monitoring services, indicating that Credit Karma was expanding the market beyond the affluent consumers who had historically been willing to pay for credit access. The broader implications of Credit Karma's success extended far beyond just free credit scores, fundamentally reshaping consumer expectations about financial transparency and data ownership. The company's success demonstrated that consumers were willing to share their financial data in exchange for free services and relevant product recommendations, a model that would later influence everything from budgeting apps to investment platforms. Credit Karma proved that making financial tools accessible could actually improve financial outcomes, as users with regular access to their credit scores showed measurably better credit improvement over time compared to those who checked infrequently through paid services. The platform's educational approach helped demystify credit scoring for millions of Americans who had previously viewed credit as something that happened to them, rather than something they could actively manage and improve. Financial literacy advocates praised Credit Karma for democratizing access to credit information, arguing that the service reduced inequality by ensuring that income level didn't determine access to essential financial data. The success also highlighted how much value traditional credit monitoring companies had been extracting without providing proportional benefits, essentially functioning as toll collectors on information highways rather than value-added service providers. Credit Karma's model influenced broader trends toward freemium financial services, with companies across the industry recognizing that charging for basic data access was becoming untenable in an increasingly transparent digital economy. The shift forced traditional financial services companies to reconsider which services truly warranted premium pricing and which were simply legacy revenue streams that could be disrupted by more customer-friendly approaches. By 2015, the transformation was complete, and the paid credit monitoring industry, as it had existed for decades, was effectively dead. Credit Karma had grown to over 40 million users, representing roughly 1 in 3 American adults with credit files, while traditional paid credit monitoring services were hemorrhaging subscribers and desperately pivoting to identity theft protection and credit repair services to justify their fees. The company's valuation had reached $3.5 billion, based entirely on the freemium model that incumbents had initially dismissed as unsustainable. Experian, Equifax, and TransUnion were all offering free credit scores by 2015, but as reluctant followers rather than market leaders, and their free offerings still felt like trial versions designed to upsell premium services rather than comprehensive solutions. The average American's relationship with their credit score had fundamentally changed from an occasional paid consultation to ongoing free monitoring, with Credit Karma users checking scores more frequently than traditional service users ever had, despite paying nothing for the privilege. New entrants to the credit monitoring space uniformly adopted freemium models rather than attempting to charge for basic score access, recognizing that Credit Karma had permanently reset consumer expectations about the value exchange in financial data services. Traditional credit monitoring companies that survived did so by focusing on services that genuinely added value beyond basic score access, such as comprehensive identity monitoring, credit repair services, or premium financial planning tools. The industry revenue model had shifted from subscription fees to affiliate marketing and lead generation, a change that ultimately proved more lucrative for companies that could execute it effectively while providing significantly more value to consumers. Kenneth Lin's simple insight that credit information should be free had destroyed a $2 billion industry built on artificial scarcity and replaced it with a more efficient, consumer-friendly ecosystem that generated more value for all participants except the former gatekeepers who had been collecting rent on access to basic financial data.